is, has said that their decision to raise or lower rates will be based on data. And as I look at the data, it seems like we're in store for another rate increase. But the events of the last week, I think, makes liquidity king now. And the Fed realizes that. And I think there's a strong probability that credit cost will go up, credit will become more expensive, and perhaps less available as banks pull back and protect their liquidity. And that will have a dampening impact on the economy and on demand, even more so than a 50 basis point hike will have. And I hope Chairman Powell will realize that.
The Fed's job is to control inflation. Yep. We're in inflation. We're with the data, exactly what Scott is saying. They've got to do their job and control inflation. Nobody likes it. Our customers say, why are the rates keep going up and up? Is it that, or is it inflation? What's the trade-off that's there? And they've got to continue to do their job.
Yeah, I agree. They need to. What are we really saying here, Peter? We're saying, listen, don't make knee-jerk reactions. And I would encourage the Fed to play the long game here and to do their job and to make sure that we tackle inflation here. I think it's still out there. I would expect everyone in this room watching on TV still feels like inflation. You go to buy something, and you're like, wow, that's really gone up. I mean, and whether it's goods or whether it's services. And I think they need to play the long game, fix this. Could they overreach? Could they overstep? Of course. But we need to tackle inflation. That's their job, and I think they'll do that. I really do. I've got a lot of confidence in them.
Peter, I have to be a little bit careful about this question because I sit on the Seattle branch board of the Federal Reserve. And so in that respect, I'm sure it doesn't go directly to the chairman's ear. I do get to tell the Fed a lot about what I think. Mm-hmm. But here's something that I think is really important for folks to understand. Mary Daly, who's the president of the 12th District in San Francisco, really listens to what interest rates impact is on families and small business. Sometimes I think we think of the Fed as this entity, and we look at the mandates and we look at the Fed governors, and it all seems either esoteric or too far removed, or sometimes even a blunt monetary instrument. But when I look at Fed presidents like Mary Daly and see how much they want to know, what's the story behind the data? What does it mean to this family? What's the impact in Alaska? I think that's reassuring. And we should remember that the Fed is keen for observations and anecdotes too. And one of the things you can do is talk to us bankers that are on these various Fed branch or regional boards and share those anecdotes. Because the data lags, right?
Right.
And we are often boots on the ground right here that really see what the impact is.
I want to, in our limited time left, Dan, I want to turn to you. You had a LinkedIn post a few days ago as chair of the ABA, but also in your role as CEO of the bank, where you made a real appeal for industry unity right now during this time of challenge. I want you to, first of all, ask you, why did you feel the need to post that? And what's your message to this audience and the bankers who might be listening on the live stream?
Thank you, Peter. And I don't have 10,000 followers, but I felt that was the voice to put it out there, a business setting, the LinkedIn post. United we stand, divided we fall. We're all bankers. Most people in the room are in a variety of different banks. There couldn't be a better example right here on stage. I'm a CEO, he's a CEO, he's a CEO, she's a CEO, but we're in different parts of the country. We're different sized banks. 100 billion, 130 million, but we're still doing the same thing. We're in this for our customers. Who's our most valuable asset in the bank? Our customers are our most valuable asset. It does no good to be negative, and I'm a very positive person, so I wanted to at least put that message out there that a united industry is strong, and we talk about the perception the resiliency of banking in general. And we need to be strong. We need to stand together and support each other. Scott is making a lot different loans in Zion's bank than what Dan Robb is making. Dan Robb will go out on the field and jump on the tractor with a customer, and I can make that loan right on the spot to that customer and do a really good job. Scott's bank is loaning internationally. Jonesburg State Bank doesn't need to. So we need all banks, large, small, business, consumer, rural, city, all those different things. So I wanted to just put the message out there that we need to be together. We need to stand strong together.
And Peter, I appreciate
Peter, I would just say we owe a vote of thanks to Chase and the other 11 banks that put $30 billion into First Republic Bank. That is a tremendous sign of solidarity. It's a sign of faith in the industry, especially since those deposits are uninsured. And I think we are in this all together. As Dan said, if one fails, we all fail. We are in this together.
On that note, I see my time is up. We're waiting for the Treasury Secretary who's squeezed us into her busy schedule. I want to thank the four of you for joining us, for sharing your stories, what's happening at your bank, and hopefully providing some reassurance to everyone out there. So thank you all.
And thank you,
Yes,
Peter,
thank you.
for a
Thank you.
great job.
Great.
Thank you for that fantastic panel. Peter, great job. And again, thank you everyone for being here. Since the first signs of stress in the banking system, the administration official leading the government's response has been Treasury Secretary Janet Yellen. It's not the first time Secretary Yellen has been asked to make tough decisions in support of the U.S. economy. Before becoming the nation's 78th Treasury Secretary, she served as chair of the Federal Reserve Board. She holds the distinction of being the first woman to hold the top jobs at both the Fed and the Treasury Department. We're incredibly pleased she could take time out of her busy schedule to join us today. Secretary Yellen will deliver some keynote remarks, and then I will join her for a brief conversation. Please give a warm ABA welcome to Treasury Secretary Janet Yellen.
Everyone, and thank you. Thank you, Rob, for your leadership of the American Bankers Association. I greatly appreciate the invitation to be with all of you at an important moment. As everyone in this room knows, the American economy relies on a healthy banking system that can provide for the credit needs of families and businesses. American households depend on banks to finance their homes, invest in an education, and otherwise improve their standard of living. Businesses borrow from these institutions to start new companies and expand existing ones. Almost 2 weeks ago, we learned of problems at two banks that could have had significant impacts on the broader banking system and the economy. The situation demanded a swift response. In the days that followed, the federal government delivered just that: decisive and forceful actions to strengthen public confidence in the U.S. banking system and protect the American economy. Let me be clear. The government's recent actions have demonstrated our resolute commitment to take the necessary steps to ensure that depositors' savings and the banking system remain safe. Our approach had two main pillars. First, we worked with the Federal Reserve and FDIC to protect all depositors in the resolutions of Silicon Valley Bank and Signature Bank. The steps we took were not focused on aiding specific banks or classes of banks. Our intervention was necessary to protect the broader U.S. banking system. And similar actions could be warranted if smaller institutions suffered deposit runs that pose the risk of contagion. I believe that our actions reduced the risk of further bank failures that would have imposed losses on the Deposit Insurance Fund, which is paid for through fees on banks. Second, we announced a new facility to provide additional liquidity to the banking system. The Fed's new lending facility, the Bank Term Funding Program, is designed to help banks meet the needs of all of their depositors. The situation is stabilizing, and the U.S. banking system remains sound. The Fed facility and discount window lending are working as intended to provide liquidity to the banking system. Aggregate deposit outflows from regional banks have stabilized. And as you know, 11 banks, including the very largest and some regional banks, announced $30 billion in deposits into First Republic Bank last week. This support represents a vote of confidence in our banking system. We're continuing to monitor conditions closely. My team and I have been in close communication with many of you, in addition to federal and state regulators, other market participants, and international counterparts. While we don't yet have all the details about the collapse of the two banks, we do know that the recent developments are very different than those of the global financial crisis. Back then, many financial institutions came under stress due to their holdings of subprime assets. We do not see that situation in the banking system today. Our financial system is also significantly stronger than it was 15 years ago. This is in large part due to post-crisis reforms that provided stronger capital standards, among other important improvements. In the coming weeks, it will be vital for us to get a full accounting of exactly what happened in these bank failures. Regulators have already announced a review into Silicon Valley Bank. We are currently focused on the situation at hand, but we will need to re-examine our current regulatory and supervisory regimes and consider whether they are appropriate for the risk that banks face today. We all share an interest in ensuring that the United States remains the strongest and safest financial system in the world. Given recent developments, I think it's important to reaffirm a broader point. Our dynamic and diverse banking system is critical to the American economy. Large banks play an important role in our economy, but so do small and mid-sized banks. These banks are heavily engaged in traditional banking services that provide vital credit and financial support to families and small businesses. They also increase competition in the banking sector and often have specialized knowledge and expertise in the communities they invest in. Indeed, many of these banks have played an important role in supporting our economic recovery. In the depths of the pandemic, Treasury was tasked with getting money quickly and responsibly to those who needed it. So we work closely with many of you to send economic impact payments to millions of families. You also worked with us to deliver advance payments from the enhanced child tax credit, which helped cut child poverty nearly in half in 2021. And we've collaborated to rapidly deploy assistance to hundreds of thousands of homeowners facing foreclosure. I also know that many of you are working with state governments to inject new financing into small businesses as part of our state's small business credit initiative. In the prior iteration of this program, lenders with less than $10 billion in assets accounted for 95% of all program-supported loans. Our administration has also been focused on working with mission-oriented banks to put us on a path toward inclusive economic growth. For example, Treasury's Emergency Capital Investment Program has invested almost $8.4 billion in depository institutions that are CDFIs and MDIs. Treasury is committed to ensuring the ongoing health and competitiveness of our vibrant community and regional banking institutions. So to end, let me return to where I started. A safe and sound banking system is integral to the health of the American economy, and we are squarely focused on doing our job. And you should rest assured that we will remain vigilant. I look forward to continuing to work together to strengthen our banking system and our nation's economy. Thank you.
Secretary Yellen, thank you for your leadership during this time of stress and for taking time not only to deliver those important remarks, but to also give us a couple of questions as well.
Sure.
Let me start, I think an obvious one, and that's kind of the path forward. You've spoken about the extraordinary action that the Treasury and the Fed and the OCC and the FDIC took, but you also spoke about, or have spoken about, the making sure we have to understand the root causes of the factors before determining whether further regulatory or policy action needs to be taken. Can you expand on that and kind of give us an idea of what you and your fellow regulators are considering? You know, where do we go from here?
Okay, very good question. So let me just start by saying that our banking system is sound, even as it's come under some pressure. As I indicated, this is different than 2008. 2008 was a solvency crisis. Rather, what we're seeing are contagious bank runs. We demonstrated last week that the federal government is resolutely committed to taking actions that will mitigate financial stability risks where that's necessary. And every step we have taken has been intended to reassure the public that our banking system is resilient and that we stand behind the banking system. The public should have confidence in our banking system, and it's our intention to remain vigilant in the days and weeks to come. And as I said in my remarks, that means potentially intervening if a smaller bank experiences the kinds of difficulties we have seen that pose the risk of contagion. So banks, of course, need access to adequate liquidity when they face deposit outflows. And really, that's the reason, that was the motivation for the founding of the Fed in 1913. So we need to make sure that the Federal Reserve is able to provide the liquidity that banks need. And we see the Fed's new facility and discount window lending as now working as intended to provide liquidity to the banking system. We're monitoring conditions closely, communicating very actively with federal and state regulators, and in touch with you and many of the banks in this room. We see the situation as having improved. Aggregate deposit outflows have stabilized. That's really what we're focused on, but you asked me to look forward. So we don't yet have all of the details about these two banks. As I said, we know, though, that this is a very different situation than the global financial crisis, when banks came under stress because they had subprime assets that lost value. And that was a situation where there was a shortage of capital. We have post-crisis reforms that have greatly improved capital standards and other important improvements in supervision. So I think there will be time, it will be necessary, but there's time to evaluate whether some adjustments are necessary in supervision and regulation to address the root causes of the crisis. I don't want to speculate at this point on what those adjustments might be. What I'm focused on is stabilizing our system and restoring the confidence of depositors. But it has been announced that Vice Chair for Supervision, Michael Barr, will undertake a thorough review of the failure of Silicon Valley Bank with an eye to determining next steps. So there will be time to consider whether some adjustments are necessary. Now we need to stabilize the system and restore confidence in its soundness.
Thank you for that answer, and also thank you for your timely comments around deposit insurance and smaller banks, and for emphasizing that in your answer. Thank you. Second question I had for you, Secretary Yellen. You know, bankers in this room today represent banks from all across the country, all across the size spectrum, from small community banks, mid-sized banks, regional banks, money center banks, globally active banks. It's the entire U.S. banking sector. Can you speak to the importance of kind of the industry working together and unity, and what banks of all sizes should be focused on right now to reaffirm the faith that customers have placed in them?
Absolutely. So let me just start by saying that community banks play a vital role in providing credit and financial services to small businesses, to farms, to consumers in thousands of local communities around the United States. And they can provide services that larger banks can't replicate because they know the special features of their markets and the people who are active in those communities. And I think the most important thing for all of those banks is to remain focused on serving the needs of their communities. We have an economy that remains very strong and vibrant. We have seen more new businesses formed in the aftermath, the last couple of years in the aftermath of the pandemic. And those businesses and households need support, and that is the prime business of community banks. So I guess I would start there. The community banks in this country, we know, are strong and resilient, and I think banks need to reassure their customers that they are strong and resilient, and the government needs to do exactly the same thing. And I believe we do have a very strong and resilient banking system, and all of us need to shore up the confidence of depositors that that's the case. So let me just say again that all of the actions that we have taken are designed to bolster confidence in the banking system and to demonstrate that we are ready and prepared to take the steps that are necessary to ensure depositors that the banking system and their deposits are safe.
Thank you, Secretary Yellen. And in fact, my own, as I opened the conference right before you arrived, talking about the strength and the resiliency of the industry and confidence in the industry and the health were exactly the themes that we used to kick off this conference. We're aligned certainly on that. I know your time is tight and you have 1,000 places to go, but as a Treasury vet myself, I have to ask you about another really important issue around financial stability. And so before the stress of our sector over the last several days, we were looking at the need to raise the debt ceiling, something you're very familiar with, sometime this summer, given the associated economic risk of not to our markets, to our economy of not doing so. Given the situation we're now in, the events of the last 11 days, how important is it for Congress and the administration to resolve this debt ceiling standoff, acknowledging that people are talking about current events, and to act swiftly to ensure the full faith and credit of the United States?
Well, I consider it utterly essential for Congress to act to raise or suspend the debt limit. I really worry about waiting until the last minute to do it. What we saw in previous debt limit impasses, and I'm thinking especially of 2011 when it took until the last minute to be resolved. The government's credit rating was downgraded, and that's the first time that's happened in the history of our nation. And that's something, this kind of brinksmanship with the debt limit, I think really imposes substantial harm. It raised the cost to the United States of borrowing, and in turn, the short-term borrowing costs of millions of consumers and small business owners. And we have the safest and most liquid financial system of any in the world. The dollar serves as a reserve currency. U.S. Treasury securities are the go-to asset whenever there are concerns about anything, any economic or financial developments around the world. And this is something that we should prize and is a great benefit to our country. And nothing should be done to throw that into danger. And so if there were a failure to raise the debt limit, I believe it would be absolutely catastrophic and take an economy that is performing very well. We've had the fastest recovery from a downturn that we've ever seen, and the fastest recovery of any nation around the globe. The unemployment rate is near a 50-year low. The economy is doing well, and it would threaten all of that. Now, that said, having a sound fiscal policy and making sure our country is on a sustainable fiscal path is vitally important. And this is a priority for the president. He has just issued a budget that contains deficit reduction in order to make sure that our debt to GDP ratio remains stable and that net interest costs that the government pays remain well contained and manageable. There are different views about what we need to do to be on a sustainable fiscal course, and the president has made clear that he stands ready to address fiscal policy. But importantly, that's a conversation that needs to happen over time and in the appropriations process, and not through the threat of forcing a default. Preventing a default, making sure that the government pays bills that Congress has already committed us to. This is simply a basic responsibility that Congress has to the American people, and it's something that needs to be done without conditions. I guess I would just mention one further thing in this regard. It's something very much on my mind. I sometimes hear it suggested that Treasury can and should prioritize payments. If Congress doesn't raise the debt ceiling, we go through a list, pay some things first and other things later. In that regard, let me just say, Treasury makes absolutely millions of payments every day, and our system is built to pay our bills on time, not to delay bills or try to sort payments into different categories and to pay some ahead of others. And there's a reason that Treasury secretaries of both parties have rejected the idea of prioritization as a risky and dangerous idea. It's never been done, and prioritizing is nothing other than default by another name. So I believe it's essential that Congress raise the debt ceiling and that they do it promptly in order not to inflict a truly catastrophic wound on our economy and financial system.
Well, Secretary Yellen, our time is up. Thank you for your leadership at this time, and thank you for your timely comments today. Please, ladies and gentlemen, please join me in thanking Treasury Secretary Janet Yellen.
Thank you very much. Thank you. Thank you.
Please welcome ABA Chief Policy Officer Naomi Camper.
Good morning. Good morning. I'm not going to lie, it's a little intimidating following the Treasury Secretary.